Why investments are important. 1. Longer life expectancy. In India, retirement generally occurs between the ages of 55 and 60. With increasing life expectancy, individuals face extended retirement years. To ensure financial stability during these years, savings alone are not enough, they must be invested to grow over time. 2. Increasing tax rates. India employs a progressive taxation system, meaning higher income results in higher taxes. Tax-saving investments, like public provident funds, PPF, or tax-free bonds, provide opportunities to reduce taxable income. 3. Interest rates. Different investment avenues offer varying interest rates, influenced by the level of risk and benefit schemes. While higher returns are attractive, stability of interest rates and portfolio diversification are equally vital. 4. Inflation protection. Inflation erodes the value of money, reducing its purchasing power over time. Investments need to generate returns that not only keep pace with inflation but surpass it to maintain real value. 5. Rising income levels. As incomes grow, individuals have a greater ability to save and invest. A disciplined approach to investing enables better financial planning and wealth creation. 6. Diverse investment channels. Economic development has led to the creation of numerous investment avenues. Beyond traditional savings accounts, options like mutual funds, equities, and bonds allow individuals to tailor investments to their goals. Factors favorable for investment. 1. Legal safeguards. A stable political and legal environment ensures that investor rights are protected. This includes contractual and property rights, which build trust and encourage investments. 2. Stable currency. Wise monetary and fiscal policies contribute to a stable currency. Currency stability ensures that investments retain their value and provides predictability for returns. 3. Financial institutions. Development banks and financial institutions play a crucial role in strengthening the capital market. They provide instruments and services that encourage savings and facilitate growth. 4. Business organizations. Public limited companies are particularly attractive due to their limited liability, perpetual existence, and transferability of shares. Such organizational structures provide safety and liquidity, making them ideal for investors. The investment process. Stages in investment. 1. Set investment policy. Define clear investment objectives, such as risk tolerance, expected returns, and time horizon. Determine the amount of wealth available for investment. Identify suitable asset categories like equities, bonds, or real estate for the portfolio. 2. Security analysis. Analyze individual securities or groups of securities to identify undervalued or mispriced assets. Use fundamental analysis to evaluate financial statements and business fundamentals. Apply technical analysis to study market trends and price movements. 3. Portfolio construction. Decide the proportion of funds to allocate to various investments. Address key elements. Selectivity. Choose the most promising securities. Timing. Invest at the right market conditions. Diversification. Spread investments across different assets to reduce risk. 4. Portfolio revision. Periodically review and adjust the portfolio to reflect changes in objectives or market conditions. Rebalance by selling overvalued securities and buying undervalued ones. 5. Performance evaluation. Evaluate the portfolio's performance regularly in terms of returns and risks. Compare results against benchmarks to ensure alignment with goals. Types of investors. 1. Growth investors. Focus on companies with high growth potential. These investors aim for significant capital appreciation, often taking on higher risks. 2. Value investors. Seek undervalued stocks that are overlooked by the market. Their strategy involves buying low and waiting for the market to recognize the stock's true value. 3. Income investors. Prioritize steady income through high dividend-paying stocks or fixed-income securities, often preferred by retirees or those seeking capital preservation. 4. Buy and hold investors believe in the principle of time in the market rather than timing the market. Hold investments for long periods to ride out market volatility. 5. Technical investors rely on market charts and patterns to make decisions. Predict future price movements based on historical trends. 6. Fundamental investors analyze financial health, management quality, and market position to identify quality stocks. 7. Angel investors provide private funds to startups or innovative projects, often motivated by personal interest or potential high returns. 8. Active versus passive investors. Active investors aim to outperform the market by frequently trading and managing portfolios. Passive investors prefer to match market performance through index funds or ETFs. 9. Emotional investors, driven by impulses or hype, often leading to irrational decisions and higher risks. Risks associated with investments. 1. Business risk. Risk of financial loss due to poor company performance or bankruptcy. Mitigation. Diversify investments across multiple industries. 2. Purchasing power risk. Inflation risk. The risk of reduced value due to inflation. Mitigation. Invest in assets like equities or inflation-indexed bonds. 3. Market risk. Systematic risk affecting all investments due to economic or geopolitical factors. Mitigation. Use asset allocation to balance risks across asset classes. 4. Interest rate risk. Impact of changing interest rates on bond prices, with long-term bonds being more affected. Mitigation. Invest in bonds with varying maturities. 5. Legislative risk. Risk of changes in government policies or regulations affecting investments. Example, changes in tax laws impacting mutual funds. 6. Currency risk. Risk from fluctuations in exchange rates, especially for foreign investments. Mitigation. Hedge currency exposure through financial instruments. 7. Reinvestment risk. The challenge of reinvesting returns at lower interest rates in a declining rate environment. Example, bonds maturing during low interest periods. 8. Liquidity risk. Difficulty in quickly converting investments to cash. Example, real estate assets, which are less liquid compared to stocks. Key takeaways. Investments are vital for financial security, combating inflation, and achieving long-term goals. A well-structured approach, backed by knowledge of favorable factors and associated risks, ensures success. Plan wisely, invest responsibly, and secure your financial future today.